Hi, I'm Sharon Winsmith, a tax attorney, active investor, and your go-to resource for proven investment and tax planning strategies. In this video, we're going to cover part 5 of our asset allocation series, and we're going to talk about alternative debt investments. I'll explain to you what debt alternative investments are. I'll share some different types of debt alternatives that you can invest in and explain when you can invest in those types of debt alternatives depending on where you are in your wealth building journey. And I'll also share my personal thoughts on this asset class and how you could think about the amount of money you should allocate to debt alternatives and how to allocate money within that asset class. So I want to start with being clear that this is not intended to be investment advice. I'm only sharing my personal opinions and thoughts on how you should think about investing your money. I am not telling you what investments you should or shouldn't make, and you always have to do your own research and make your own decisions. So let's just start by a quick reminder that we're talking here about layer 1 versus layer 2 asset allocation. So layer 1 here are, the different asset classes. Here we're dealing with debt. So that is, we're going to dive into this specific layer 1 asset class, which is debt alternatives. And I'm going to talk about allocating layer 2 allocation within that investment class. So the reason I split up fixed income, which are traditional forms of, fixed income type investments that we talked about in the prior video in this series, where, you think about like bonds and things like that. I split that apart from debt alternatives because I think that they operate very differently. The types of returns that you can get are very different. Just the way you should think about investing these assets and the way they operate and the types of investments that, are covered in these different asset classes. I just think they're very different. And I think you should think about them separately the same way I do. I think it makes the most sense once you really understand the different types of investments that you can make. So with that said, let's talk about what are debt alternatives. So I know this is a term that may not be familiar to a lot of you that are newer to this type of investing, but when I talk about debt alternatives, I'm really talking about debt instruments that are not publicly traded. So yes, most of these investments are fixed income in the sense that you're getting a steady stream of income, similar, when you think about something like a bond or a CD or a savings account. But as I mentioned before, I like to separate these out because I think they're very different. They're much more complicated usually. They're much more, I think, sophisticated. And just quite frankly, I think they're better investments. I would never touch fixed income. I've been very clear about I do not invest in fixed income, traditional fixed income investments. I do think there are some types of debt alternative investments that are much more attractive and just better investments overall. So that's another reason to separate them out. But we're really talking about, debt instruments that are not publicly traded. They're not things that you can just go out and buy, in your portfolio, like bonds, for example. And, they're things that I think are much more sophisticated. In a lot of cases, you're going to find that these types of investments are limited to accredited investors, such, when you're investing a lot of these things through funds, like investment funds, you may find that, you're always going to have to be an accredited investor. Basically, if you're investing through a fund and, it's a good quality sponsor, a good quality deal, they're going to almost always require you to be an accredited investor. But that doesn't mean you have to be an accredited investor to invest in debt alternatives. I'll talk to you about some other forms that are just available to everybody. So just a good example of this, this is pretty basic stuff. We're talking about just any type of loan, for example. So let's say you lend your friend Bob $10,000 with a 5% interest rate for 10 years. Bob's basically borrowed $10,000 from you. Bob's going to, hopefully pay you that money back in 10 years. But in exchange for lending Bob that money, he's going to pay you 5% interest every year. So you're getting $500 from Bob every year. This is obviously just a private loan between you and your friend Bob. So it's not publicly traded. So I would consider this a debt alternative investment. And, this is just a traditional loan. This can be, take a lot of different forms. But, at its basic foundation, this is really kind of the infrastructure of what we're talking about with debt alternatives. So let's just talk a little bit about the different types of investments you can make in debt alternatives. So the example I shared before is private lending. So that's just, your uncle reaches out to you, wants you, to loan him some money, or, your friend Bob, as I mentioned, that's just private lending. That's just where, you're going to directly lend to a borrower. So like I said, it's not publicly traded. Everybody can't do it. It's just whatever private arrangement. And most of us, once you make money, unfortunately, you're going to have some friends that probably come to you and offer to borrow money. I personally would never do this. There's a number of reasons why I think private lending is bad. Why is that person coming to you when there's so many good forms of, good lending out there that they could go to? Why do they need the money? So I don't touch private lending. I think, any deals or investments that involve friends or family, I just have a blanket no, because those just never seem to end well. And if they do go bad, then, the relationship that you had with that person is going to be sour. So I don't touch private lending. It's just, there's a number of reasons that I'm not going to dive into here. But so debt funds, and there is a little bit of overlap here. So a lot of these different types of investments I'm going to talk about can be structured as a debt fund. But a debt fund is just, think of it like an investment fund, like a real estate fund, for example. You pull capital from investors the same way as if you're going out investing in real estate, but instead of buying properties, the fund is going to invest in various types of debt instruments. So the types of debt that the fund can invest in can be anything. It can be a wide range of types of investments, or, when I say investments, I'm talking about the debt, instruments themselves that the fund's investing in. It can really be, across a lot of different types of industries, a lot of different forms of debt and how it works. But keep in mind, a lot of these can be structured as a debt fund. Bridge financing is when you're, just lending with respect to a short-term gap. So, a lot of people, if they're, building a new home, they might have to get a bridge loan just to, cover some cash they need for the short term before maybe the old mortgage, before they get money out of their old house and pay off the old mortgage. You might need some cash to get your new mortgage or something like that, to pay the purchase price for the new house. So just anytime there's really a short-term gap that you need to fill, then, bridge financing is really something that, is a good form of lending. I like this type of lending. I'll talk more in the next section about why that is. This is my favorite type of debt alternative investment to make, and it's really the only one that I would ever consider. Syndicated loans, I'm not going to dive in because this really can get quite complicated and sophisticated here and complex, but syndicated loans you might have heard of. That's when you have a group of lenders that are, gathering together and going to issue a loan. So that can get, much more in the commercial setting. You might have like a group of banks that get together and syndicate a loan to give to a very large, real estate developer or something like that. But that's really when you've got a group of lenders that are going to kind of come together and issue, lending that way. Litigation financing is very popular recently. So I know a lot of people who invest in this. What you're doing is you're, financing a lawsuit in exchange for a share of that potential recovery. So, in exchange for, lending that money, you're going to get, some upside, hopefully potential if they win the lawsuit. So litigation financing, I think, is very popular over the past few years. And it's really, this is obviously specific to lawsuits, but there's other types of niches that I'm not going to cover because it could just go on and on. But there's other types of niches and industries where, they might need financing to finance something and you get a share of upside in the recovery in the future or some sort of upside kicker. But I just use litigation financing because I think that's the most popular people have heard of. Peer-to-peer lending has gotten really popular lately with these online platforms. I really think of peer-to-peer lending as being, lending through these online platforms like Lending Club, is a big example. Funding Circle, I think is, one I hear a lot of people talk about. I don't do these. I don't think they're good for kind of similar to the private lending. Good quality investments are not coming on these platforms. They're just not, right? And I don't like them for a number of reasons. I'm not going to, belabor this point, but peer-to-peer lending is getting very popular. I don't think savvy, sophisticated, smart investors should really pursue that option as, a way to make investments. So lastly, just distressed debt. I'll mention this one. This is really, when you've got someone who's borrowing money, but they're in financial distress, right? So like a company, for example, who is, maybe they've already gone bankrupt or, maybe they're about to go bankrupt and they just need kind of emergency funding. The typical bank's not going to lend to them in most cases because there's too risky. There's too much of a risk that they won't get paid back. But you would hopefully be getting a very high interest rate on that loan because it's extremely risky. It's probably the riskiest type of investment, you could make in debt, but you hopefully get compensated by just a crazy high interest rate on that. So I want to mention distressed debt because there are people who just kind of specialize in that and like that because of the high returns. I don't do it. It doesn't make sense to me because it's way too risky. And I think there's better ways, that you can get equally or better returns than by, taking on the risk of investing in distressed debt. So with that said, now that we've kind of gone through, and those aren't all the types of debt alternatives out there. I just wanted to share some pretty common examples you see in practice. There's endless types of investments you can make, and you'll find that when you dive into this world. But I want to talk a little bit about how I personally invest in debt alternatives and my thoughts on just this asset class as a whole. So it shouldn't come as a shock to a lot of you. I don't like this asset class. I very rarely, if at all, invest in debt alternatives. I have in the past. And the only time I've ever done that is through bridge financing. So I only invest in debt alternatives through an investment fund. So that means, same way as real estate, I would find a good sponsor who specialized in these types of deals, find a good deal that I thought aligned with my objectives and my goals. and then I would invest in that. And the reason I only like bridge financing might become more clear, after I talk about why I don't like this asset class. So a big reason I don't like this asset class is that you've got, I think, a bad risk return trade-off here. So you only get, remember, I don't invest in things that are below 10% returns. That's my minimum threshold. I'm not touching it. I've got too many good investment alternatives out there that I think are very safe and not a lot of risk. So I'm not investing in something that's below 10%. It's just a waste of my time. To get above that 10% threshold and to get any meaningful return in, debt alternatives or just fixed income in general, you have got to take on, I think, an unnecessarily large amount of risk. So I think to get above 10% and start getting a decent return that makes any sense for someone like me to invest in, the risk is just too high at that point. It doesn't make sense. So like, for example, I can go out and I can invest in a private equity fund that's typically kicking off average returns of 20% or higher a year, or I can go invest in something like debt alternatives that aren't getting anywhere near that and I think are significantly more risk. So to me, it just doesn't make sense. Or, I could go out and buy a business or, invest more into my existing business and get 50% plus returns on that, and you might think that's probably a little bit more risky than me investing in a private equity fund, for example, but the returns are so much higher. And it's certainly nowhere near as high as if I tried to go out and invest in distressed debt, for example, or, something like that. That's just extremely risky. So my personal opinion is that I don't think the returns that this asset class provides typically justify the high level of risk you're taking. So where I think there can be an exception to that is with bridge financing. I'll give you an example of a bridge financing debt alternative investment that I've made in the past. So there was a fund that was organized around providing financing to landlords who lease their property to cannabis growers. So this was at, years ago, the investment started a couple years ago. Banks they won't touch, or I don't even know how it is now. I think it's starting to loosening up a little bit, but banks previously wouldn't lend to cannabis growers at all. So if you wanted to go out and start a cannabis business, the banks weren't touching you, right? They didn't want anything to do with that. They also would not lend to the landlords who rented space to the cannabis growers. So this fund and the fund managers who were brilliant, saw this opportunity and decided to create, an investment around that. We were getting really high returns, 15, 16%. I didn't think it was super risky because we were, able to, if something went wrong and, the cannabis grower leasing that space, we didn't own the property. We were lending to the landlords who owned the property. If for some reason, the cannabis grower that they were leasing to at that point stopped paying rent or went bankrupt or whatever, then we still owned, had the ability to foreclose on the property. So the property, it was kind of like real estate investing, but you got higher returns in a sense that you were providing a gap because no banks would lend to this. We were the only people really who were willing to lend to this specific group of people. So that's why I liked it. It was also set up as a REIT, so it minimized some of the tax impacts. I'll talk a little bit more about the tax inefficiencies with debt alternatives. So it did minimize some of that to some extent. And the returns justified, I thought, the risk we were taking, which I honestly didn't think was that much. I was a fan of the cannabis industry. I'm not a user, but I was a fan of the industry. I think I don't see why banks can't lend to them or shouldn't have been able to. I don't see why we still have all these, laws against, those types of things in a lot of states. So I had no moral issue with it. And I thought it was a great opportunity to exploit for a couple years. That changed once the banks were loosening those rules and were able to start lending to these spaces, and interest rates obviously went down on our investment. So I redeemed well before that happened. So this was it was kind of a short term, but you're not like buying something. It's not like buying a property that you're going to sell in a couple years. This was really kind of a short-term liquidity play. But, long story short, that was the only type, of debt alternative investment I've done in recent years. And it's the only type I probably, would ever consider is this type of bridge financing investment through an investment fund. Historical performance. So the returns can really range. And I'm going back to talking about debt alternatives as a whole and why I don't like debt alternatives in asset class. Historical performance can be anywhere, 6% at the low end. It could even be lower depending on where interest rates are, to 15% or higher. I talked about my cannabis REIT, bridge financing investment that I did. That was getting returns over 15%, in the heyday of that when that was doing well. And, distressed debt, you're obviously going to be, potentially much higher than that. But again, we get back up here with distressed debt. Yeah, those returns might look good, but the risk is just crazy at that point. Tax inefficiencies, the same tax inefficiencies that exist with fixed income, traditional forms of fixed income like bonds, CDs, those types of things, savings accounts, they still exist here, right? In most cases, the income's all ordinary income, interest income, taxed at ordinary income rate. So that's not good. And, I don't think that when you're looking, especially at the returns and the risk you're taking to get those returns, which are already kind of low, then you add in the tax efficiencies. I just don't like it. I do think it's a better asset class than fixed income because the returns are better. Even though you're still got the same tax inefficiency, you're starting with a pre-tax return that's much higher than something like a bond is typically going to kick off. So that is the one thing. I do think debt alternatives are better than fixed income, but I still, in case that isn't clear, don't love this asset class. There is a bit of a lack of transparency when you're investing through things like an investment fund. This is my experience. So you may say the same is true with real estate, private equity, whatever. I haven't found that to be the case. I think when it comes to investing in debt alternatives through investment funds, or just when you're, in a big pool of other investors and you're looking at really big deals, I think you find in practice that you have limited knowledge of what exactly you own and what's in the loan portfolio underlying, the fund itself, what it's investing in. And I never really feel like you have a clear indication of like underwriting strategies, things like that, that'll help you feel a little bit better about the risk you're undertaking. So if there were better transparency, I might be more, likely to invest in some of these deals that come through that have good risk return, trade-offs. But in my experience, I just find it's not that the operators in the space aren't good. I just find that it's just the way, I think the nature of the industry and the way it works is that you can't, some of these loans are small and you just can't know kind of, everything the fund's going to own. But when it's something where I think there's such a risk return trade-off issue here in this asset class, I think you really want to understand what you're investing in and what the strategy is. And I just don't think that exists in practice a lot. So that is why, I'm not a big fan of debt alternatives. I've mentioned the limited situation where, I wouldn't invest if it's bridge financing through an investment fund. That's a good opportunity. With that said, now let's talk about how much we should allocate to debt alternatives. So I fully recognize there are a lot of really smart people who like to invest in this space. So a lot of savvy investors I know won't touch, traditional fixed income because they know that doesn't make sense, but they do like debt alternatives. They like to have a small portion of their portfolio. They like the steady stream of income. It's really kind of a psychological thing where, with debt alternatives, you can expect that, 10% whatever returns to hit your bank account every month or so. So people like that. They think it's good for asset preservation. There's some reason people think you're not going to lose your money. I think this is just as risky, if not more risky than other asset classes that kick off double returns and, significantly higher returns. But for some reason, I just think it makes people feel better to invest in these types of things. So, if you are someone who really wants to have that kind of steady stream, predictable income, then maybe this is something you want to have a small piece. With that said, my opinion is you should keep these allocations to a minimum. Right now, I have absolutely no investments in the debt alternative space. So my asset allocation to this asset class is 0. If you're a non-accredited investor, the only thing you can really invest in are things like private loans. That's your friend or buddy coming to ask to borrow money. Peer-to-peer lending platforms sometimes, you're not able to invest through investment funds. You're not going to get access to these large deals like litigation financing, good quality deals in that space. So I personally think you shouldn't allocate anything to this space because the types of investments that you can do as a non-accredited investor are just not great, right? I think private lending is a disaster. I definitely would never do peer-to-peer lending. So, I personally wouldn't allocate anything to this. If you were to become a credit investor or a qualified purchaser, most of the funds in this space are going to mostly be open to accredited investors. They don't typically require you to be a qualified purchaser like they do with private equity, venture capital, and that type of stuff. But once you hit that accredited investor, status, I think you could think about allocating a portion to this, asset class because you are able to invest in debt funds. You are able to get access to that deal I mentioned about the bridge financing to, landlords in the cannabis space. So, that's when I would start to think about allocating a portion to this asset class if you so desire. I don't think you have to. As I mentioned, I don't allocate anything to this asset class. I don't see myself doing that in the near future, even with interest rates as high as they are right now. It just doesn't make sense from a tax standpoint. And from the, risk reward trade-off for me, I've got too many good assets or investments that I can make that it just doesn't make sense to, not invest in those better investments in my personal opinion. But, I would keep it to a minimum, 0 to 5%. I wouldn't go too high here. Again, it's going to create a bad tax situation for you. and the returns aren't going to be that great unless you're just taking on some crazy amount of risk. If you are going to do it, my recommendation is through debt funds. I would never, as I said, do the, sort of private lending. Anything peer-to-peer, I think is, not good quality usually. So I would only do this through debt funds. You can, I have a course where I talk about how you can get access to these investment funds. It covers real estate, it covers debt funds, it covers private equity funds, venture capital, any type of investment fund that you could, want to invest in. My course covers how you can get access to the good quality deals in those spaces. And that would include these debt funds, of course. If you are someone who wants to allocate a portion of your portfolio to this asset class, then the next step is to figure out, how to get access to quality deals that are going to invest in debt that you can consider adding to your portfolio. So this was my overview of debt alternatives. This was part 5 of the asset allocation series. In the next module, we're going to cover part 6, which will be real estate investing.